Richard Yasenchak last year, passively managed funds or index funds beat actively managed funds once again. They've been doing it since 2008. Why do you think that actively managed funds are going to come back and win this year?
I think because of cyclical tailwinds will prevail with active management. And what I mean by that is what we've observed over time is there are cyclical tailwinds associated with active and passive investing. And what we've seen in this current environment over the last 3 and 5 year period is that there have been tremendous tailwinds associated with that of passive investing. And we also tend to see that passive investing does quite well in periods of double-digit gains, like we've observed over the last 3 to 5 years, in which the S&P 500 has now been up about 15% annualized each year.
And you say that passive management is inefficient, because you got to explain that to me, because I thought it was the model of efficiency.
Yeah, I believe so. It is inefficient because when you think of passive investing, in essence, what we really want to do is protect on the downside in order to achieve better long-term returns on the upside. And passive investing feels the full force of the down equity markets, where active investing could actually protect on the downside through better risk management.
All right. Well, you also say that passive isn't truly passive. Can you explain that?
It isn't truly passive because when you make a decision to go to passive from active, you're making a very active decision in making that transition. And so we feel that if you're making that decision at this moment in time, you have a belief that you'll continue to see double-digit gains within the equity markets on a forward basis. Now, that may be the case, but we feel that to be very unlikely. And active investing, active management does much better in moderately rising markets as well as down markets because it's benefiting from compounding effects. And we all know that if the market were to drop 20%, you need 25% just to break even. Or if it drops 50%, you need 100% back just to break even.
And costs compound as well. So if I had Jack Bogle in here, he'd say, what about the transaction costs? So I'm going to ask you, what about the transaction costs?
Yeah, I do agree that when you think of passive investing, it's inexpensive, it's transparent, and it's easy. However, again, you're feeling the full downside of the equity markets. And if you think of the kind of returns that we've seen over the last 5 year period of 15% annualized for the S&P 500, essentially that has moved investors from riskless to risky assets, and they've sought out beta, just getting pure exposure to the equity markets. But when markets moderate or go down, investors are willing to pay for alpha, and they'll need that much needed alpha because of these compounding benefits associated with active management.
All right, so say you want to say goodbye to the benchmark and you want to go for the alpha. How does INTECH do it? How does INTECH go active?
Yeah, INTECH does it by creating more efficient portfolios than a cap-weighted or a passive index. And we do that by varying weights based on correlations and volatilities of underlying stocks. And then we seek to outperform the cap-weighted index over longer periods of time based solely on volatilities and correlations through systematic rebalancing.
All right, thanks a lot for coming in.
Thanks a lot, Greg. Appreciate it.
Thank you for watching The Street.